Welcome to Balancing the Ledger, where tech and finance intersect. I'm Jen Viechner.
And I'm Robert Hackett.
And today we're joined by John Stein, the CEO and founder of Betterment. Thanks so much for being here, John.
Thanks, Jen. Great to be here.
Yeah, so Betterment now advises $17.9 billion in assets. It's what some might call a robo-advisor. So this is kind of like set it, forget it investing. You invest, go into ETFs, and it's kind of automatically rebalanced. You are also launching into some new products, though. Tell us a little bit about that.
Right. So what we've been known for is bringing the very best technology to money management, right? Starting with your investments. And everyone knows that we help our customers make the most of their long-term money. But as we've gone down this journey, we've heard from so many customers that to get them further down there, it would help if we could better manage their everyday cash, their everyday money. And if we can help them save a little bit more, that's super impactful. So we're launching both a savings account and a debit card with a checking account attached that I believe will be the best in market of both of these products. The savings account is going to have what is the highest rate in the market. Today, it's yielding 2.69%, which makes it by far the highest yielding savings account. The debit card is going to have no fees at all whatsoever, no minimum balance, no fees on any ATMs, no network restrictions, nothing like that, and internationally free ATMs as well. So really market-leading products for all of our customers who are looking to make the most of their everyday cash. One of the things that we've done is really intelligently structure this product. So we've negotiated with multiple banks. We're working with a range of banks on the back end, just like we do on the ETF side, right? We're able to choose the best ETFs from multiple providers to give the very best value to our customers. And as an independent advisor, we're always working for our customers. We're always working to make the most of your money. A bank only makes money if they pay you less. We're able to get the very best rates in market, and we pass all of that on to our customers. And that, I believe, is extraordinary value that we can provide as the market-leading smart money manager.
So you're not collecting a spread on this?
That's right. We're just passing all of it to you, the customer.
Okay, so whatever the bank is paying you, you're then paying the customer.
Correct.
How are you able to commit to it being the highest? Because I think the highest rate on the market right now is offered by your competitor Wealthfront, but you can commit to it being higher than that no matter what, even if the Fed lowers rates.
So interest rates are interesting, and they're set by the Fed. Short-term rates are anyway. And all the banks kind of key off of these. And long-term interest rates also key off where people think short-term rates will go over the long term, naturally. Most of the large banks haven't really raised their rates at all. Even as interest rates have been coming up, they've just been banking that as profits. We're going out with a market-leading rate above the current Fed rate, and even if the Fed moves their rates, our rate will continue to be above that Fed rate. That's how we've structured the contracts, which is unique. It's a commitment that we've made to providing the best in-market rate for our customers.
So it's pegged to the Fed funds rate?
Correct.
And how much higher is it going to be?
It's somewhere between 25 and 30 basis points.
Okay.
Last year, we saw Robinhood. They came out with another high yield, what they called checking and savings account. And they said it was FDIC insured. It was a huge debacle. It turned out it was not insured. They had to roll this all back, delete any posts about it. And now, we're kind of waiting to see how that cash management thing is gonna work. How are you avoiding this sort of scenario for yourself? Have you spoken to the relevant regulators? Is this thing going to be insured?
And to clarify, they said it was insured by the SIPC, and are you saying it's insured by the FDIC?
That's right. So ours is FDIC insured up to $1 million, which is more than the other limits that are out there, because we are splitting your deposits across multiple banks. Again, because we're not acting as the bank, but as your advisor here, we're able to get you a better deal than you can get from a traditional bank. The problems that Robinhood ran into, as has been reported, were largely self-inflicted. They ignored the regulators. We have always worked closely with our regulators and continue to do so in this case to make sure that we're providing a product that's great for our customers, but it's also compliant.
So they've signed off that these accounts will be FDIC insured?
Correct. These accounts are FDIC insured. They're held at banks.
Got it.
If a company like Robinhood were to come out with something that, as they wanted to last year, is a 3% yield, are you going to try and beat that with your own yield provided on your account?
So remember, that's just pure fantasy. And I can't comment on fictional unicorns and things like that.
You're not making any money off this because you're just passing along everything that you're making from the banks and interest. How do you plan to make money from this?
So one of the ways that we make money, in fact, the only way we make money today, is through our advisory fee that we charge for the advice we provide on your investments. That's 25 basis points. It's, I believe, the lowest in the market. We continue to provide that service at the same cost for all of our customers. We would hope that some customers come to us, and because we have this market-leading rate, they're going to say, wow, like I'm interested in checking out Betterment. By the way, we also earn you more than anybody else on your retirement money, right? We earn you 40% more on average over the long term than you could if you even invest in the same ETFs that you could buy through us on your own. Because
Investment
of our smart
returns or savings?
investment returns.
Huh. So
right?
you can promise that?
Well, nothing is promisable
Yeah.
over the long term, but yes, because of our tax optimization, on average and over time, the average customer will have 40% more cash. It might be more, it might be less, but that's the average expectation based on the algorithms that are running today. And we're just getting better and better every year. We're getting smarter and smarter. Our technology is getting better.
A lot of big companies, a lot of big banks, they've been releasing their own robo-advisors. We've seen Fidelity, Schwab, JP Morgan just recently came out with one, and they've been slashing fees left and right. JP Morgan doesn't charge you, I believe it's on the ETF fees, it waives those fees. So with all of these fees coming down to maybe zero across the board, how will that affect the fees that you take out in your product?
So we haven't seen zero yet. And I think there's a difference between zero and something. The JP Morgan product is at 35 basis points, which is more expensive than ours, even after you factor in ETF costs. And remember, we're able to choose the best ETFs from all of the providers out there. We don't have any backdoor deals to make money off of ETFs. Every other competitor in the market is either double dipping by offering you their own funds, which they make more money on and which aren't in your best interest, or they have some kind of payment system that's not in your best interest. We only make money on that advisory fee, and that independence means that we're always acting in your best interest in giving you the very best funds.
Yeah, because you're also, in addition to the free checking and savings, you also have a free debit card that has no ATM fees worldwide. Is that right?
That's right.
How do you think about which products, you're still charging 0.25% on the invested assets. How do you negotiate between what you want to offer for free and what you want to charge for? And is there a day that it could ever come down to zero?
My mission has always been to make the most of our customers' money so they can live better. And I believe that the way that we do that is by being aligned with our customers. We're very customer-centric. I believe we've created the most customer-centric financial services company. We will continue to be true to that commitment. We will not make money on our own funds. That is not a customer-friendly practice that most of our competitors have done. In our savings and checking products, we've been very thoughtful about how we've structured them so that we can offer the customer the very best deal. On the debit card, we'll make money on interchange. So when you swipe, just like your credit card company or the merchant acquirer or all these other payments processors make money when you swipe, that is a source of revenue for us. So obviously we want you to carry the card and use it. But you don't have to, right? Like we're making these services available to everyone because we believe over time, many of our savings and checking customers who are starting to save more, and we're going to encourage them to save more and more, will become our long-term investing customers.
It sounds like you've tried to undercut a lot of the discount institutions out there, whether it's Schwab, Fidelity, or Vanguard. I mean, if you're trying to undercut them, what does that make them do? I mean, is everybody just becoming less profitable over time?
I think we're just offering more value because we're structured differently. We're able to, we have no branches to maintain. We don't have this legacy infrastructure. We've built really smart technology so we can provide a valuable service at a lower cost to our customers.
Well, John, thank you so much for being here.
Thank you so much for having me. It's great to be here with you.
I'm Jen Viechner.
And I'm Robert Hackett. For more Balancing the Ledger, come to fortune.com.
We'll see you next time.